Hello, everyone. In today's teaching session, I'm going to review network analysis and compare this to correlation analysis. And after we do this, we're going to look at an example of doing some pairs trading for stocks. Okay, so what is pairs trading? It's basically a market neutral strategy that looks at historical price movements of two stocks that were correlated at some point in time, and then they start to deviate over time. So why is this important? If we're looking at the correlation, uh, possible reversion to some kind of mean or continued price divergence, we might be able to exploit these concepts and generate excessive profits from the market, right? Rather than just randomly throwing darts at the dartboard or just picking stocks that we like, if we have some kind of affinity for. You really want to understand the statistical movement of a stock's price over time and try to anticipate what's going to happen next, right? You want to get emotional. You don't want to get fall in love with a stock, because the stock will never fall in love with you, right? I can guarantee that. So you want to remove all the emotion and just keep everything as mathematical and statistical and as I guess as precise as possible, right? But you want to get emotionally involved in decision making for your investments, right? So we're gonna look at a few different trading strategies. Of course, divergence or convergence of stock prices. Will this continue? Will this revert to some kind of mean? We would expect, if two stocks were trading with a pretty tight correlation, this means that the prices moved relative to each other pretty closely, right? Like if you have a statistical significance at 0.7, if the correlation is 0.7 or greater, these two stocks are going to move very closely together and they should not deviate. However, if they start to deviate, this could be an opportunity for a profit, right? Because we expect them to converge again and move together again. So we're going to, there's some classic examples, right? Burger King and McDonald's, Verizon and AT&T, they're in similar businesses. They are going to provide similar services or similar products, right? These are the types of companies that we'll typically focus on. But two stocks can be highly correlated in price and not be in the same industry or the same sector. So we have to be cognizant of that as well, right? We don't have to find stocks that are industry specific or they perform in the same industry. They could be across industries. If the stock price is historically very tightly coupled with another stock, right, it has a high correlation and that deviates, that's what we want to look at. So let me go ahead and pull in some data here. I will refresh this Jupyter notebook. And by the way, I'm going to share all this data with everybody here, so you don't have to worry about taking notes or understand all the details of what's going on in this Jupyter notebook. I'm going to save this and post this when I post the video, so you'll have access to everything. Okay, you can simply download the file that I'm going to load when I load the video, and you'll have access to all of this logic right here. Okay, so I'm going to import some fundamental data from this website I found. It's called finviz.com. I have another video about how to do these imports. I'm not going to get into it now, but you need to employ a couple libraries, specifically Beautiful Soup, and we're going to look at this base URL and we're going to import this data from the URL. So I have all the Dow 30 components, plus I threw Google in there. Google is not in the Dow 30 as far as I can tell, but I think that's a good comparison or a good stock to look at for making potential pairs trading. So I just threw that one in. But typically, the stock list is just the Dow 30, but this can be anything, right? You can loop through any list of stocks. This could be the S&P 500. This can be whatever couple dozen of stocks that you have some kind of proclivity for. That's fine. You can make this up. It's very dynamic. You can import historical data. I'm sorry, not historical data in this case. You can import fundamental data for any ticker that you put in, as long as it's covered by FinViz. So let's see what this code did when it finished running. We have the index here, that's the ticker symbol. PE, that's the price of earnings. EPS, that's earnings per share over the trailing 12 months. That's what TTM is. Insider owned, shares outstanding, performance for the week. Market cap is the number of shares times the price per share, right? So we have about 72, was it 72 or 76 different metrics here, financial metrics, and these are all fundamental ratios for all of these stocks. So this is pretty nice. You don't have to actually calculate it yourself. You don't have to go and get all the financial data and calculate your own ROA and ROE and PEG ratios and PE ratios, right? It's just given to you by this website, so it's very convenient, very very useful to grab it there, and you'll save yourself a ton of time. So let's do a little cleanup, because some of this data comes in with B's and M's to represent billions and millions. Sometimes you have percent signs, sometimes you have commas. We want to strip this out and just get pure numeric data. Okay, so I'm going to run the cell. I just did the import. I'm going to run this code to do a little cleanup on the data and just basically prepare it to be able to run some analytics on this data. So let me go down a little bit, and cleanup is done. And you can see how pretty quick and how very efficient this Python code runs, right? With just a few lines of code here, you can do some really amazing things quickly and easily. So everything's cleaned up. We set an index on our data frame. We have 31 stocks and 76 components or features of fundamental data for these 31 stocks. Remember, I included Google, so it's about 30 plus 1. We're going to look at an elbow analysis here to understand how many stock clusters we should be breaking our overall population into to understand these, to understand how to cluster these stocks. So the elbow method is going to go ahead and iterate through a few different numbers in range. I have a range set 0 to 20, and it's going to see if it continues to plot higher number of Ks. So the K means we're going to look at 1 through 20. Is the performance going to be better, or is it going to plateau at some point? The plateau is going to be the flattening of the curve, right? Where the curve bends at the most significant part. That's the optimal number of clusters that we should pick for our K-means analysis. So I did this. It looks like it's around 5. I suppose you could say maybe 4 or 5. Definitely by 5, it's flattening out. The bend might be slightly higher at 5 or 4, but I'm going to go with 5 and just use that. Okay, so I'm going to set that in this next cell here. I have n clusters equals 5. So if I double click on that, you will see that right here. Okay, so I'm going to set the number of clusters to 5, and I'm going to go ahead and run this. So Control Enter to run the cell and get the update here. Okay, and based on, let me scroll up just a bit here. Okay, based on volume and change, we're doing our clustering, right? And when we look at a plot of the cluster, that is just down here. Again, we're looking at 2 features in that fundamental data frame. So we have PE and EPS. And we'll go ahead and hit this to refresh it. So Control Enter will do the refresh for us. And we'll see the plot. So we're only using 2. Beyond 2, it's really hard to plot data. You can do a 3-dimensional plot. After that, 4, 5, and 6 dimensions are possible. But it's very confusing to understand what's going on, and it gets even more confusing. That's if you know what you're doing. To explain that to some stakeholders, which maybe are not super tech savvy, like yourself and myself. So beyond 2, maybe 3 plots. If it's interactive, a 3-dimensional plot might work X, Y, and Z, but really 2-dimensional plots are really ideal for a lot of these things. So that's why we only have 2 variables that we're plotting, the price of earnings and earnings per share. And if we mouse over this, we'll have the balloon pop up to show us all the details. So here's the EPS and the PE, and then the index, right? So the color corresponds to the number of the index that this stock falls into. Yellow is going to be lighter, right? And that is going to be index number 4, and dark purple is going to be index 0. So a lot of these look like they're 0s and 1s. If we go down here and print the results, we'll see what this looks like. So print DF cluster. So there's the data frame and the column. It's called cluster. That's the ID. So we have 0 through 4. We only have 1 for it looks like INTC. So I looked at this one a few days ago. INTC is down a lot this year. I think it's down like 60% or something like that. So that one really goes into a cluster of its own, because the stock is performing quite different from all the others. And a lot of these stocks are going into the same cluster. So you can see Home Depot, Goldman Sachs are both in cluster 0, as is XXP, JP Morgan. These are all cluster 0. And again, this is 0 base. So we have 0 through 4. I said, give me 5 clusters, but it always starts with 0. It doesn't start with 1. That's how you get 0 through 4, right? So the code above created the clusters for us. Whoops, I'm going to delete this. This is the first time I'm seeing this. I'm going to cut this out because this is not relevant. I was making some edits to this just before I turned on the recorder. Okay, so I just caught that. Okay, so these videos are all made in real time. I don't stop and edit anything. I put the code together before and test it to make sure everything works, but it's not 100% cleaned up and ready to go. Sometimes you have to make small modifications and adjustments as you go. Okay, so this is the first analysis I want to introduce you to. The clustering was just a fun exercise just to see how things are working together, or how everything fits together in the relationships between different features in the fundamental analysis data frame. But this is where the rubber really meets the road. This is the beginning of the network analysis versus the correlation analysis, and that's what I want to focus on going forward. So network analysis is a great way to look at correlations between data points and find out how well they are clustered. So it is relevant to the cluster experiment that we just saw just above this, but it's kind of a different approach. It's doing a network analysis to go ahead and derive those clusters. So a network would be similar to your connections on LinkedIn. That's an excellent example. Or your friends on Facebook. That's another example, right? You can be friends with 100 people, and each of those people will be friends with other people, right? So you can be a friend of a friend and connect with somebody that your friend is friends with, right? And you might have something in common because you have this common friend. So you can see other people's profiles and say, yes, this person looks interesting. I'm going to contact that person. I want to talk to that individual or whatever, right? So that's what clustering analysis helps us to do. In this stock example, we're going to look at how similar different stocks are, not our friends, but based on the correlations of these stocks and how well the prices move together historically over time. I'm going to say if you move pretty tightly together, you belong in the same cluster. Okay, I want to analyze that, and then I want to visualize that. So that's what this code is doing. We're doing a very simple correlation analysis right here, DF correlation. So that is a data frame with all the fundamental data, the PE, EPS, PEG, ROA, ROI, so on and so forth. And we are going to take all of these fundamentals, right, and see how well these are clustered together. So we can see the PEG, the EPS, and EPS next Q. So these are actually linked. Here's all the nodes, and the connection between the nodes is a line. So I believe this was set at 0.8. I think 0.8 was a cutoff. Let me go down a little bit here. Yeah, threshold is 0.8, right? So 80% strength in the correlation to have a connection between the different nodes. So we see that with EPS, TTM, and EPS next quarter. And that's what I'd expect, right? Because the earnings per share is going to be highly related to the last quarter earnings per share. And SMA 50, that's a simple moving average, last 50 days, and RSI for the last 14 days. These two have a relationship, right? So we see the line connecting those two nodes, but actually nothing else does. And this this chart is somewhat useful, but really it's kind of just sitting there. It's not interactive. It's really not doing a whole lot for me. And it doesn't really show me a whole lot of clustering other than the SMA 50 and RSI being connected, and then those EPSs, right? So I want to go ahead and try a different type of analysis. I'm going to go down here and look at a similar type of concept. So this is another network analysis experiment that I'm going to run, but this is going to give us an interactive chart that we can play around with. Okay, so rather than the static kind of old school visual rendering here, we're going to get something that actually is pretty cool when you see this thing. The first time I had a big smile on my face when I saw this first time. It was pretty interesting the way they set this up. So now we have all the clusters of stocks, and you can actually click your mouse on this and drag it around a little bit, right? And this cluster will move. And other clusters, they're not in this cluster, are going to get pushed around a little bit, right? They have to get out of the way because they don't belong to this cluster, right? So you have to be in a different spot. So if you start moving this thing, you can see how it's very interactive, it's very visually engaging, and you can see how you can move these fundamental features around, right, and see what the connections are and the relationships between each of these. If I go over here, just dragging and dropping, now this other cluster is going to be forced to relocate or dislocate because my first cluster that I'm interested in seeing here, this is the ROE, the price to book, and long-term debt and debt to equity. Yeah, so that totally makes sense to me. Okay, so the debt to equity and long-term debt are clustered together, right? And these EPS and TTM and EPS next quarter, we knew that those were clustered together from the previous example. But one thing that wasn't fleshed out prior to this was these other features here that are actually in the same cluster. So now we have attribution, price, target price, and previous close. So the price, target price, and previous close are going to be clustered together. Totally makes sense to me. I didn't realize that the EPS and EPS TTM are also in the same cluster as price, but that kind of makes sense if you think about it, right? You have the stock price, earnings per share. So the stock price and earnings and the number of shares are going to be somewhat related, right? And that's exactly what we see. We see 80% or higher correlation, right? If you don't meet that threshold, you go into a different cluster. If you meet the cutoff there, then you go into these clusters. So I thought that was pretty cool. I want to showcase that. So let's go down a little bit more. Getting some excellent results here. So I did put together a couple notes and a few thoughts. Let me just read through this quick. So the interactive network chart is very relevant. It's very useful to show us the relationships between these different financial ratios, right? And then the correlation has to be 0.8 or greater for them to make it into this cluster. Otherwise, it goes into a separate and distinct cluster, right? So each node represents the feature in that fundamental analysis data frame, and the edges represent the correlations between the features, right? So the features are like price to book, price to cash flow, stock price, EPS, things like that. And then the correlations show us the lines connecting those different nodes, right? So the correlation strengths basically show stronger and weaker correlations, right? The strongest are put together and the weaker ones are actually correlated together, but with a different group, right? It just goes into a different group of friends, like on Facebook or on LinkedIn, right? So let me go ahead and pull in some historical data. Now, this is coming from Yahoo Finance, and this is going to be not fundamental data now, but this is going to be all historical time series data for stock prices, closing prices coming from Yahoo Finance for the past 6 months, okay? So the code is a little bit complicated. It's actually not too bad. And again, I'm going to share all of this when I post a video. I will download this code and save it as an HTML file where you can download that and click it to open it, and you'll have everything that I see right here. You'll see this on your own screen. So I'm going back in time 6 months, okay, getting daily prices. So this is going back, this is September 12th. So it's going back to, I think, February 12th. I think that's where we start, right? It's going back 6 months, March, April, May, June, July, maybe. Oh, I misspoke. Okay, I see it there, March 12th. Okay, so March to September, that's what we're looking at. And that is 180 days worth of data. So if we go down just a little bit, we will see the data imported here. And then, let me go up a little bit. I demoed this in a couple other videos. So if you saw my other videos, this is kind of old school at this point. I mean, this is old hat at this point, right? So if we go down a little, we'll see all the historical data there. And then the price, the corresponding price with the closing stock price data, right? Or I'm sorry, the corresponding date and the stock price, okay? So I'm going to go ahead and create a correlation matrix. So this is going to look at all the correlations between all of these stocks, okay? It's in the first example, it was a little bit more different type of analysis based on network correlations. This is just looking at the changes between the X and Y variables. The X and Y is each stock relative to each other stock, and how tightly correlated that is. Again, if the stock is 0.7 or greater correlation, we can call it statistically significant. If it's less than 0.7, it's not going to be statistically significant. And anything greater than 0.7 is going to, these stock prices are going to be coupled together and they're going to move pretty closely together. So if one goes up, you can expect the highly correlated pair to go up, and if one goes down, you can expect to go down for the most part, but they do deviate, and that's why we're looking at this pairs trading scenario at the end here. So we have all of our correlations done based on the historical data. That's fine. Let me go ahead and just plot this out so we can just visualize this real quick. So on the diagonal here, you'll see every stock is perfectly correlated to itself, of course, right? But when you look at each stock relative to all the others, I'll look at the first column here, Apple. So the ticker is AAPL, right? We can see Apple and Amgen have 0.29 correlation, Apple and Amazon 0.34, Apple and AXP. This is 0.10. BA is Boeing, that's 0.28, Caterpillar 0.18. So Apple doesn't have a high correlation in any of these stocks so far that I'm seeing. Let's try to find something that's 0.7 or greater. J&J actually has a negative correlation, 0.09 negative. But I'm not seeing any high correlations with Apple and any other stocks. And then you have Walmart at the end, and that's fine. But the nice thing about this correlation matrix is that it shows you visually, like the darker color reds are going to be more highly correlated, and the lighter blues have less correlation, right? And actually, I do see 1.7. So there's one statistically significant correlation, and if we go up, this looks like JP Morgan. Okay, and if I go to the left, JP Morgan has a high correlation with what? If I go to the left over here, quite all the way over. It's actually Goldman Sachs. Okay, so it kind of makes sense, right? Like JP Morgan and Goldman Sachs are both in the banking sector, financial institutions, pretty massive, right? Both are behemoths, and the stock performance is pretty similar, 0.7, right? And we would expect that to probably continue, although if it starts to deviate, I want to know about that because that could be a good trading opportunity, okay? So let me go back, let me go down here just a little bit more. So what's the takeaway here at this point, right? Before we step into the pairs trading example. So network analysis was the first example where we had those interactive clusters that we can drag around, and that was kind of neat to see them bouncing around on the screen like that. So we have visual insights, pattern recognition. That's what the clusters are showing us, right? And overall basic clustering based on similarity of those different communities. Like all those stocks, right? If they're similar, they're going to be clustered together. What does the correlation analysis show? It's a simpler, traditional, classical statistical analysis. It's a little bit more straightforward, probably easier to compute, easier to run, easier to interpret and to share with your stakeholders. The network analysis is probably more convoluted, but it's doing some more sophisticated stuff too, and it's a pretty sexy way to analyze the correlations between anything, right? Your network of friends on Facebook or LinkedIn or stocks. So you have to kind of pick one and go with it. At this point, I'm going to go with the classical statistical approach, the standard correlation analysis. Okay, and I am going to run that. So I'm going to set a couple of parameters here. I'm going to say correlation threshold. This really should be 0.7. I did this just before I turned on the recorder. I don't think we'll get any results, but I'll test it just to make sure. So if I run that and go down, we say 0.7 is statistically significant, right? Anything greater is fine. Anything less is not significant, but we don't have really anything. You saw it was just barely JP Morgan and Goldman Sachs, and then you have a couple other parameters that I set here is the Z threshold and a time window going back 90 days. So it's not enough to trigger any kind of pairs trading opportunity. So I am going to relax this threshold just a bit and go down to 0.6. Now, this is kind of just gaming it because I just want to see some results. Really, 0.7 is where you want to be, or even higher, right? But just to illustrate the point here, I'm going to set this to 0.06. The Z threshold is 0.5, right? And the time window is 90 days. So 90 days back in time. And again, we have 180 days worth of data. So some of these things are arbitrary, right? So you would have to decide how far do you want to go back? Do you want to go back 6 months, 12 months, 18, 24 months? That's up to you. That's why you would pick that at the beginning of this import. I showed you we're going back 6 months. In this case, I think that's perfectly fine. For your needs, you might want to go back shorter or longer. It's really up to you. So that is somewhat arbitrary. But you just have to think about what you're trying to do too, and does it make sense? Is this relevant and does it make sense to your analysis? If so, then go with it. If it doesn't make sense, then maybe there's no pairs trading opportunity. I would say I wouldn't say there is an actual pairs trading right here, right now, but that could change in a few days or a few weeks. Over time, you'll see these come on the radar and then fall off the radar. but I just want to show you what this would look like if we relax it just a little bit and went down to 0.7. I'm sorry, 0.6 instead of 0.7. So you see Caterpillar and Dow are diverging with a z-score of 1.62, and this is a possible trade signal. So let me go over to Caterpillar and Dow. These are two components on the Dow 30. And if I look at this, Caterpillar, Dow. Okay, I think I have to refresh this because I only see one there. Oh, no, it's there. Okay, so it did refresh. So Caterpillar is bouncing around a lot, but recently in the last 90 days, it's been trending up. And you can see historically, this is 6 months, right? Yeah, 6 months back. You can see that the correlation was pretty high between the two. That's why the pairs trading algo they just ran flagged this thing as a possible pairs trading. So it's not like super tight, right? Because we relax it, we're only saying 60% correlation, not 0.7. But again, I wouldn't have anything to show you if I left at 0.7. So I just want to show you how this works. So I set to 0.6. You can see back for the previous year, certainly 6 months ago, the stocks, these two stocks, Caterpillar and Dow, were trading somewhat similar, about 60% correlation. But recently, in the past couple of weeks, I guess since even August, even like early August, they're both dipping down together. Then Caterpillar started to go up and Dow started to go down. So here's the deviation. That's why this model is picking this as a pairs trade opportunity. We're saying that Dow is down and Caterpillar is up. But historically, they've been trading together. So either Caterpillar has to come down or Dow has to go up, right? Because this is a more of a market neutral trading strategy. So there's no guarantee. Is Caterpillar guaranteed to come down? No, there's no guarantee whatsoever, right? And is Dow guaranteed to go up? No, of course not. But we would expect historically that these two are trading with a pretty tight relationship, at least 0.6 or higher, that these will converge again sometime fairly soon, right? So we expect the Caterpillar to go down and Dow to come up. But, that's not perfect trading strategy. The market can remain irrational. There's an old saying, the market can remain irrational longer than you can remain solvent, right? So if you put money into that and it starts losing, you put more, you start losing more, you put more, you start losing more. That is one possible outcome. But we're trying to use market insight and logic here to prevent that from happening. We would expect those two to reconverge. Okay, so here's another example. Google and Microsoft are diverging with a z-score of 2.02. Possible trading signal. Let's look at this. This is what the model is recommending. Google and Microsoft, and we go over here. Okay, and let me go up just a bit to get more info on the screen here. Whoops, it's expanding the chart. I didn't want to do that. Okay, Goldman and JPM. And let me go back 1 year just for a quick sanity check. Just let me see what this thing is doing 1 year ago. Okay, and 6 months, that's the time frame we're looking at. So you can see these two banking institutions are trading pretty tightly together, right? It's like 0.7 we saw. If one goes up, the other tends to go up. If one goes down, the other tends to go down. But right here in the past several days, maybe 1 week or so past, you can see Goldman is definitely trending down. Goldman's pink. Oh wait, I'm sorry, JP Morgan. JP Morgan's trending down and Goldman's trending up, right? So they're starting to diverge historically for at least 6 months. When I say historically, I mean, let's be honest, it's not lots of history, but for the last 6 months, these two have been trading fairly consistently, right? That's why the correlation is pretty high. But now Goldman is sort of breaking out on the upside, and JP Morgan is kind of going through the floor. It's kind of breaking through the resistance level there. Resistance? No, breaking through the support level. Sorry, I misspoke. So Goldman is going through the resistance level. JP Morgan is going through the support level, and they're diverging, right? We expect them to converge eventually. So when is that going to happen? Nobody knows. You can't say for sure, right? But this is probably another good pairs trading opportunity. The two stocks tend to trade pretty tightly together, right, with pretty high correlation. Now they're deviating. That's why the model recommended this. So in this scenario, it would buy JP Morgan and or sell Goldman. And in this scenario, we would, let me flip back here. We would sell Caterpillar, right, and buy Dow because we expect those two to converge. So that's it. Let me go back to the model here real quick. and we can wrap it up. And again, I will share all this code with you, so don't worry about taking notes and understanding all the details and all the nuances. At this point in time, I'll give this to you, so you can have the code forever. You can use it, run it, take it apart, reassemble it, understand how everything works together, and hopefully you'll learn a ton from this exercise. I have my notes here. I won't spoon feed all of this and read this to you off the page, but I did have a summary description here of the advantages of pairs trading and then the risks and challenges of pairs trading too, right? There are some inherent risks here. This is not investment advice. Don't take this as a holy gospel and go try to employ or deploy these strategies and then you lose money and you get angry at me or try to sue me. Please don't do that. I'm not going to be responsible for that. It's not investment advice. It's just an explanation of how pairs trading works. Okay, so I will upload the video later today, and I'll upload all the source code with the video as soon as I wrap it up here. Thanks for your time today. As always, hopefully you guys learned something new. I love putting these videos together. I always learn something when I do these things, and I try to learn at least one new thing every single day. Hopefully you can too. Thanks for your time, and have a wonderful day.